A major player just got their silver trade frozen at the exact worst possible moment. And the public explanation being pushed is, oh, it's just volatility. Nothing to see here. And I wasn't going to make this video. I'm standing here with a coffee that's gone cold, trying to pretend I'm having a day. And I'm scrolling and I'm thinking, what just happened in the silver market? It annoys me because the loudest headlines are giving you a neat little fairy tale, and I think you deserve the full story. So here it is. It's Friday, February 6th, New York time. Okay, step back with me for a second. We just lived through one of those ugly stretches where everything feels like it's sliding at the same time. You've got people tossing around the phrase worst day since the 8s, and you've got chatter about a recession that could be the nastiest in a generation. And then right in the middle of that emotional fog, you get this silver storyline that's almost too clean, too cinematic, like it was written by somebody who wanted regular people to look in the wrong direction. And that matters because silver isn't just a chart. Silver is a weird hybrid. It's a monetary metal when people get scared, and it's an industrial input when the world is building things. Solar panels, electronics, medical components, all of that. And when you have a market that is both fear trade and factory metal, it tends to behave like a wild animal. It doesn't sit nicely in a spreadsheet. Here's the core event as it's being described. One individual on the Shanghai futures side built a short position that was not merely big. It was the kind of big where you start asking, wait, how can that even exist? And to make it messier, the reporting around it uses different versions of the person's name, not stated or unclear which spelling is correct, but it's being presented as one person, one outsized position, one problem. And it wasn't treated like a normal trade. The account was frozen. The trader reportedly can't adjust the position for roughly a month, a chunk of time long enough for the market to do what markets do, move. Think about that for a second. Being short means you're betting on price going down. If you're short and price goes up, you bleed. If you're short and you're locked, you can't even manage the bleeding. You're strapped into the roller coaster with the lap bar stuck and a sign that says, enjoy the ride. Now, the simple villain story is he was trying to crush the price. Maybe, but it's not the only possible story because other motivations exist in the real world. Hedging, arbitrage, spread trades, even a dumb miscalculation that grew legs. Not stated or unclear which one applies. I'm not in the guy's head and I'm not in his books. I'm just telling you that when a narrative is too neat, you should at least leave room for a second explanation. What we do have is the label naked short, meaning it wasn't clearly backed by the physical metal. And we have the response, a freeze and a public spotlight. We also have size descriptions that put the position in the hundreds of tons neighborhood, while the reported warehouse inventory was described as a low hundreds of metric tons situation. That's how you get a ratio. That's not just over 100%. It's meaningfully above it, like beyond the that seems risky zone, and into the who approved this size in the first place zone. Based on inventory updates, the pile was already tight, then it got tighter. And that's why this isn't just a trader story, it's a confidence story. When players doubt the stock, they stop trading price and start trading the fear of being last in line. And then to add fuel, there was a sudden removal of a sizable slice of the remaining silver from the Shanghai vault system. Something like a fifth of what was left, give or take, depending on how you round it. And that matters because if the pie gets smaller while the short bet stays the same, the short looks even more extreme on paper. It starts looking closer to 1 1/3 of what's available, not just barely over the line. Now, here's where the plot thickens. The position wasn't just frozen quietly, it was exposed publicly. The story says details surfaced through anonymous sources close to the exchange. That could be a genuine leak. It could also be a controlled release, or it could be internal politics, or it could be a warning shot, not stated or unclear which, but the effect is the same. Everybody now knows there's a whale-sized short sitting there, unable to move. And what happens when you tell the market where the trap trader is? The market does what the market does. It sniffs opportunity. It doesn't always, but it can. The phrase that gets thrown around is maximum pain. I don't love that phrase because it sounds like meme talk, but the concept is real. If enough participants believe a short is trapped, they may try to push price higher to force covering. That's the essence of a squeeze. But hold up. Before we all start cheering like this is a sports game, remember silver is also one of the easiest markets to whip around with leverage. That's the second half of this story. And it's the part most people ignore because it's boring until it isn't. There are essentially two worlds, the paper world and the physical world. In the paper world, you're not buying bars. You're buying promises, futures contracts, exposure. You put up a fraction of the total value and you control a lot more metal than you paid for. That's leverage. And leverage is fun until it turns into a trap. Now, when volatility spikes, exchanges do what exchanges do. They raise margin requirements. They say, hey, we need more collateral. And if you can't post the extra collateral, you're forced to sell, even if you don't want to, even if you think the trade is right. Forced selling is not a theory. It's a mechanism. And we're being told there were repeated margin increases in a short span, not just one, multiple close together, effective after today's close. Silver's margin jumped a lot more than gold's, which tells you they're trying to cool the wilder beast. And that matters because if you stack margin hikes on top of volatility, you can shake out a lot of leverage positions. And the people who get shaken out are usually not the institutions with endless balance sheets. It's the smaller guys, the folks who thought they were investing, but were actually renting exposure. Now, am I saying margin hikes are evil? No. Margin exists for a reason. Markets need guardrails. But I am saying it has an effect. And when you look at how silver behaves around margin events, it's not crazy to think these policy moves can act like a pressure valve, or depending on how cynical you are, like a lever. And I'm not pointing fingers at any specific group. They're all great. They all wake up in the morning thinking, how can I serve the public? Just like every hedge fund manager is basically a therapist. So we've got this Shanghai situation on one side, and we've got the Western futures world tightening screws with margin on the other side. And then, because reality loves chaos, you get a geopolitical alert telling people to leave Iran. Again, we're not verifying it here. We're just tracking the storyline. But the effect of that kind of headline is easy to understand. Safe haven demand can spike. And when safe haven demand spikes, gold and silver can catch a bid. So now you've got forces that can fight each other. A trapped short narrative that can encourage buying, margin hikes that can force selling in paper markets, and geopolitical fear that can motivate people to grab real stuff. And right in the middle of all of that, the price is bouncing around like it drank 3 energy drinks. The chatter says, we saw a rebound of a handful of dollars on the day, and it's back above where it started the year. It also says, double-digit percentage moves have become routine. And honestly, that tracks with what you see in any market when leverage gets crowded. One day it's up, the next day it's down, and suddenly everyone's acting like a 10% move as a weather report. Here's the part that people miss. Volatility doesn't just scare people. It transfers contracts. It transfers patience from the impatient to the patient. It also transfers narratives. The winner isn't always the smartest. Sometimes it's just the person who isn't forced to do anything today. Now, there's another detail in the story. The trader allegedly made a lot of money during a flash crash, something in the several hundred million neighborhood. Currency not stated. And that's not a small detail, because if you're talking about whether money can be moved out of a country, you should care what currency in what jurisdiction. But we don't have that, so we keep it where it belongs, unclear. The basic point is this. The trader allegedly won on the way down, and now he's stuck on the way back up if it goes back up. That's the risk. And if the market believes the trader is trapped, the market may test it. Not because markets are moral, but because markets are opportunistic. This is not personal. This is hunger. Now, a quick historical parallel helps your brain file this away. We've seen extreme positioning in metals before. We've seen concentrated trades become political issues. We've seen exchanges step in when the game starts looking like it might break the table. The names and dates change. The pattern rhymes. Leverage builds. Liquidity disappears. Rules change. And the people who didn't understand the rules learn them the hard way. That's why I keep saying don't just stare at the price. Stare at the plumbing, inventory, margin, liquidity. Those boring words are where the story lives. So, when you hear someone shorted more silver than exists, you should immediately ask in which market, paper or physical? Because in the paper market, it's entirely possible to have claims stacked on top of claims stacked on top of claims. That's the nature of derivatives. The physical market is slower and more stubborn. You can't print a bar. You can rehypothecate a promise. Not the same thing. And this is where I want to challenge one key assumption people slip into. They hear short frozen and they assume silver must rip higher. Maybe, but not automatically, because the price most people quote is heavily influenced by paper flows. If margin hikes are forcing liquidations, you can get downward price pressure, even while physical tightness exists. That's the weird split-brain reality of this metal. So, it's completely possible to have a world where physical inventory is leaving vaults, and yet the paper price is getting slapped around. It's confusing. It's also normal for this market. Now, let's talk about that vault removal, because that's the detail that keeps nagging me. If a meaningful chunk of metal exits vaults right after the story breaks, you have a few possible interpretations. 1. Normal logistics. Metal gets moved, reassessed, reallocated. 2. Somebody is taking delivery because they don't trust the paper system. 3. Somebody wants to reduce visible inventory because visible inventory is a signal and signals matter in a squeeze environment. Not stated or unclear which one is true, but the fact that it's highlighted tells you it's being used as a storyline device to make the situation feel even tighter. And that brings us to the leak angle. People are saying the public exposure was a message. Don't do this again. That makes sense. Regulators love deterrence. Public embarrassment is a tool. But even if it was deliberate, the motivation could be more complicated than punish the guy. It could be about preserving market credibility. It could be about sending a signal to other participants. It could be about internal power struggles. We don't know, so we don't pretend. Okay, so what do we do with this? First, if you're trading silver with leverage, understand you are playing a game where the rules can change mid-and. Margin requirements can shift, liquidity can vanish, spreads can widen, and if you're on the wrong side, you don't get to argue with the exchange. You just get the bill. Second, if you're holding physical, your experience is different. Physical holders care less about intraday noise and more about availability and premiums and delivery time. And in stress periods, physical markets can disconnect from paper. That's not conspiracy. That's logistics meeting panic. Third, if you're just watching, this is a case study in how narratives get constructed, because the official story people default to is usually the cleanest one, not the most complete one. Volatility happened, a big player got caught, regulators stepped in. Those can all be true at a high level, but the why and the second-order effects are where you either get insight or you get whiplash. Now, I want to add some fresh context that matters if you're trying to understand the environment. We're coming out of a period where risk assets were priced for perfection. Cheap money trained people to buy dips and ignore volatility. Then liquidity tightened, and suddenly everything that depended on leverage started showing cracks. You saw it in tech. You saw it in crypto. You saw it in pockets of credit. When leverage unwinds, it doesn't unwind politely. It snaps. And metals sit in a weird spot in that cycle. They can be the hedge people run to, but they can also be the piggy bank people smash to cover losses elsewhere. So you can see gold and silver drop on a day when fear rises simply because somebody needs cash. That doesn't mean the long-term narrative changed. It means forced selling exists. You also have industrial demand trends that are not going away overnight. electrification, grid upgrades, energy transition hardware, data centers. Even if you hate the buzzwords, the physical build-out is real, and silver sits inside that. Not every use case is huge by itself, but the combination matters. On top of that, you've got governments thinking more openly about strategic materials. Again, not a claim about a specific policy here, just broader context. The world has been reminded that supply chains can be weaponized. When that happens, stockpiling becomes a concept people take seriously. That's not a silver-only story, it's a commodity story. So when someone says the fundamentals haven't changed, I get what they mean, but be precise. Fundamentals can be intact while prices are chaotic. Both can be true. That's why risk management is not optional. Now, back to the trader, because the human piece is what everyone latches onto. We're told the trader currently lives in Europe. We're told it's unclear whether regulators will allow the winnings to leave China. That's a fascinating detail because it hints that this is not just a market story. It's a jurisdiction story. It's a control story. It's who has leverage over whom story. And if you've ever watched markets during prosper stress, you know this. Money moves freely until it doesn't. The rules are invisible until they are painfully visible. That's why that remains to be seen detail matters, because the outcome isn't only about price, it's about permissions. Now, do I think this one frozen short will single-handedly determine silver's future? No, that's where people overreach. Markets are bigger than one trader, even a big one. But does it matter? Yes, because it reveals something about how the exchange is willing to act and how comfortable participants are with extreme positions. If authorities really are cracking down on outsized naked shorts, that changes behavior. It could reduce the willingness to do these trades, or it could push them into less visible corners, not stated or unclear. But behavior changes when consequences become real. And now we get to the part where everybody wants a prediction. I'm not going to give you a neat price target like it's a fortune cookie. The chatter includes people talking about silver moving into the 100s and even toward the low 200s in a future surge. That's not impossible. It's also not guaranteed. The market can make you look foolish in both directions. What I will say is this: if volatility stays elevated, expect more headline-driven swings, expect more margin adjustments, expect people to overreact to inventory prints, and expect the commentariat to declare victory after every green day and declare doom after every red day. So here are the practical things I'm watching, and you can watch them too, without being an insider. 1. Do we get follow rough buying after the freeze, or does the paper market suppress it with forced selling? Watch how price behaves around major contract windows and margin changes. You don't need a PhD, you just need to notice patterns. 2. Do vault inventories continue to fall, or do they stabilize? If inventory keeps draining, it adds fuel to the physical tightness narrative. If it stabilizes, the squeeze story weakens. 3. Do we see the exchange loosen the freeze early, or does it hold for the full stated period? If it holds, it increases uncertainty. If it loosens, it suggests the goal was signaling, not punishment. 4. Do geopolitical headlines keep escalating, or do they fade? Because safe haven demand is emotional. It comes in waves. When the wave hits, metals can spike. When it recedes, people forget why they bought. Now, let me ask you 2 questions because I want your read on this. First, do you think the public exposure was a genuine leak or a deliberate warning shot? Comment your take. Second, if you had to pick, do you think the next big move in silver is a squeeze higher or another forced liquidation drop? And tell me why in plain English. And one more thing, because I see this a lot, if you're successful, share your success story in the comments so others can stay motivated. Seriously, people scroll these videos when they're stressed. A real story helps. Now, a lot of people keep using the reverse Hunt brothers framing. Here's how I think about it without the drama. That famous story is about a concentrated position trying to dominate a market. This is being described as the mirror image because instead of trying to push price up with a giant long, someone is alleged to have pushed pressure down with a giant short. Fine. The symmetry is cute. The important lesson isn't the direction, it's the structure. Concentration plus leverage plus a small market equals fragility. That's the lesson. Silver is not as deep as people assume. It can be moved. And when you add derivatives on top, it can be moved faster than the physical can respond. That's why you get those violent candles that make people feel like they're watching a slot machine. And that brings us to the retail-ready idea people keep repeating. The claim is that the world is running out of easy-to-buy silver for normal buyers. Not stated or unclear in terms of proof inside the storyline. But the phenomenon itself is real. The wholesale market can be functioning while retail products are scarce, because the bottleneck isn't the metal in the ground. It's fabrication capacity, logistics, and dealers widening spreads during chaos. So if you're thinking, I'll just buy on the dip, I do it too. Understand dips in paper don't always translate into cheap physical overnight. Premiums can rise, availability can tighten, delivery times can stretch. That's why people get frustrated. They see price down on a screen and they can't buy the real thing easily. That disconnect matters. Now, let's address the flash crash and the profit, because it's the part that sounds like a movie. We're told silver fell hard in a very short window, over the mid-teens in percentage terms, and in some accounts, the hit was closer to a third. That phrase is vague, but the meaning is simple. Leverage amplifies pain. If you're on margin, a move that looks survivable in spot can be catastrophic in a leveraged product. And that's why I keep hammering this. If you're using leverage in silver, you are voluntarily walking into a room with a slippery floor and then acting shocked when you fall. Don't do that to yourself. The trader allegedly profited during that crash. And now, with the position frozen, the market has a chance to see if those profits were realized and banked or if they were paper gains that can evaporate. Because an unrealized profit is just a story you tell yourself until you close the trade. And if you can't close the trade, that story can change quickly. Now, I also want to caution you against one more trap. The temptation to assume regulators are on your side. Regulators aren't rooting for longs or shorts. They're rooting for stability, optics, and control. If they think a squeeze will embarrass the exchange, they might intervene. If they think a short will destabilize the market, they might intervene. The goal is not your profit. The goal is the machine not breaking. So, what happens next? We have a roughly month-long window where the trapped position, if the story is accurate, can't be adjusted. That's a natural countdown clock for attention. People will watch it like a reality show. And in that countdown, every inventory update and every margin update will be treated like a plot twist. In the West, margin policy matters. If margin keeps rising, it can cap speculative enthusiasm. It can also push people away from futures. In Shanghai, the willingness to publicly shame an oversized position matters. It may change how aggressive participants get. And in the real economy, the recession chatter matters because it affects industrial demand expectations. If factories slow, some demand slows. If stimulus ramps, some demand returns. If energy investment continues, demand can remain sticky. This is not one variable. One quick sanity check. There's a big market drawdown number being repeated in the chatter, but the baseline isn't clearly stated. That's important. People throw around drawdowns without telling you what they're measuring, not stated or unclear. So if you hear a huge percent, don't swallow it whole. Ask down from what? The same skepticism applies to the trader's name being spelled a bunch of different ways. That doesn't invalidate the story, but it does tell you the information chain is messy. And when the chain is messy, narratives get distorted. So here's my working interpretation, and I'm owning that it's an interpretation. A trader built an extreme short in Shanghai silver futures. The exchange or regulators froze it. The freeze became public. Visible inventory appeared to decline. Western futures markets tightened margin in the background. Geopolitical fear headlines added a safe haven layer, and the price whipped around, punishing leverage and rewarding patience. That's the story. Not magic, not a single cause, a cluster of forces colliding. Now, what should you do personally? That depends entirely on what you are. Trader, investor, collector, curious observer. I can't pick your strategy, but I can give you a rule that survives most market regimes. Don't let your position size turn you into an emotional hostage. If a chart move can ruin your sleep, you're oversized. Reduce it. You'll think clearer. And if you've been stacking silver for years, you already know this is a long game. You remember when prices felt boring. You remember when the idea of silver and triple digits sounded like science fiction. And now we're living in a world where people say those numbers out loud without laughing. That should tell you something about how fast sentiment can shift. So let me wrap this up with a few takeaways. 1. The freeze matters because it shows enforcement and it shows vulnerability. A big position can be stopped. 2. Inventory moves matter because they affect confidence and they affect squeeze psychology. 3. Margin matters because it is the hidden hand that forces people to act when they don't want to. 4. Geopolitical headlines matter because they inject emotion and emotion moves metals. 5. The market can be right about the long term and still hurt you badly in the short term if you're leveraged. If you got value out of this, subscribe. It's free. It helps the channel survive, and it helps us keep pushing back on lazy narratives. And don't forget, comment our John AG if you support the campaign to eliminate copycat channels. All right, I'm going to keep watching the next updates like the rest of you, and I want to hear your takes in the comments, especially on whether you think the exposure was a warning shot or a real leak, and whether the next big move is higher or lower. And just to be crystal clear, because I take this seriously, this is educational content. I'm not your financial advisor. I don't know your situation, and nothing here is a recommendation to buy or sell anything. Make your own decisions. Manage your risk.